It's now my pleasure to introduce our next speaker, Jim Rutt. Jim is former chair of the Board of Trustees of the Santa Fe Institute, longtime Board of Trustees member. If you look at Jim's bio, we try to be quantitative here at the Santa Fe Institute. I won't say anything about the mean or median or mode of the bio, but I can say that the variance is probably larger than anyone else on the program. So, but do read Jim's bio. He has a wide range of interests, both in the corporate world and in academia. He's the only person in the room, I believe, who was called by the New York Times the Internet's bad boy. And although there are other Internet bad boys in the room, and he's also the only person who, I believe, has given a talk entitled, "Sometimes You Just Have to Shoot the Puppy." Jim, welcome.
Thanks, Chris, and it's great to see you, Chris, back on your feet and back in the swing of things. First, before I get on here, let me do a little bit of context setting with respect to Jordan's amazingly good talk. While Jordan's talk was very big, very broad, and very theoretical, I'm going to be bringing it down a lot to a fairly tangible example of some new thinking about a currency, and particularly in this case, a monetary system. Secondly, I use a pruning rule to think about things like this, which I call minimum necessary radicalism. And all three words are equally important. Minimum, but necessary. In fact, if we look at our American political establishment today, it's all about kicking the can down the road and never doing what's necessary. How many times a month do I say, they've just kicked the can down the road? So necessary, and then radicalism. Don't be afraid of big change, but no more than necessary. And then finally, to sort of put in context between what I'm talking about and what Jordan is talking about, and also the discussions we had, at least around our table, is the distinction between centralized and decentralized. I want to make an important, I think, distinction, which is the difference between decentralized infrastructure and or centralized infrastructure and centralized or decentralized signaling. It's perfectly capable to have a decentralized signaling network that's not corrupted by artifacts in the network that might happen to have a centralized infrastructure, as well as vice versa. You could have a decentralized infrastructure which is nonetheless highly manipulated by built-in forces. So, and in my case, I believe it's the decentralized signaling that's critical. So with that, let me get started. Let's see here, newfangled devices, how they work. Oh yeah, there we go. Okay. First, again, a little bit of distinction making. People often talk about alternative currencies, and I actually started my road into thinking about money about 6 years ago when I became infatuated with the idea of alternative currencies. This was before Bitcoin, and so I researched dozens of alternative currencies that have existed over time, and their successes and mostly their failures. But this is not one of the traditional ones. So it's not a supplementary monetary system, an example of which is the Swiss weir, a couple $1 billion a year in an alternative currency used in middle-tier businesses in Switzerland to settle accounts. It's not a local currency like Ithaca hours or hundreds of other local time bank currencies or chamber of commerce currencies. When I was a kid, in fact, our hometown had wooden nickels that the merchants gave out as kind of a local currency. And nor is it a borderless cryptocurrency like Bitcoin. What my dividend monetary system is it's a national money system. First and foremost, taxes are payable in it. And as I've studied monetary systems, one of the things that's jumped at me very, very strongly is the nature by which the money diffuses through the network tells you a lot about the system. And having taxes payable in a currency provides a tremendous attractor which drives a current in the system, which brings the system to life. And in fact, in the early days of currencies, that was when you really knew you had a currency, is that was successful, was when the sovereign said taxes will be payable in it. Second, legal tender status, which is you can use it to buy anything. And the idea here, literally, that dividend money would replace the current US dollar. our current system, in brief, it's a central bank directed system. So there's Federal Reserve in the middle, as we know, and a bunch of banks around it. It's a fractional reserve system. And depending on how much you study banking, and I know most people don't, most people still have a hard time understanding the fact that 90% of our monetary system was just made up by the bankers. They just wrote a number in a book. They have a ledger. They wrote down, I made a loan to somebody for $50,000. They just wrote down in the ledger $50,000. And the person that received the loan started writing checks, and money started flowing out into the system. Literally, no lie, that's how 90% of the money that's currently in circulation got there. And that's a key attribute of our current system. And here's one that very few people have focused on in the past, but has really attracted my attention. Ours is a multi-ledger system. Every bank has its own ledger. So all the banks are writing their own numbers down and making up money, and then they're trying to coordinate it. For instance, dad sends a check to his daughter. Does that sound like something that's familiar? Okay. Daughter deposits it in the bank. The bank notifies the bank the check was drawn from. The bank that it was drawn from says, yes, there's money there, and here it is. And then the daughter gets the money. So there's tremendous communications back and forth amongst these ledgers. It's unbelievable. And in fact, you start to scale that up, it's a giant mess with a huge number of expensive and sloppy transactions going on. And an example, the payments process built on top of that for a single credit card transaction looks like that, believe it or not. Okay, so what are the problems around this system? One is, as you might expect, such an amazing kludge being used countless times a day. It's amazingly expensive. The non-loan bank fees in a typical recent year are $250 billion merely to have our money exist and to move from point A to point B. No more than that. This is not talking about loans or anything else. To give you a sense of the scale of $250 billion, it's about 150% of the total new housing construction in the United States in a typical current year. It's about 80% of what the country spends on higher education. It's about 50% of the total sales of the auto industry. So it's a gigantic number essentially spent for what's a ministerial function, writing numbers on books and comparing number A to number B and saying this number B later less than number A, et cetera. So it's really, really expensive. It's also sloppy and slow. I did some fresh research creating this presentation, and I'm surprised to find that the time in flight of checks is reduced some, but it's still in the 2 to 7 day range, clustered closer to 2 than it used to be, but they still typically reserve at least 7 days. And that slop in the system facilitates classic frauds, bad checks, check kiting, et cetera. And during the 2008 crisis, it became a serious matter of increasing instability in the system, where these guys are trying to work these deals to keep their risks modulated and buy and sell things. Literally, the closing period, interbank, it's several hours, but it's not instantaneous, and that adds a lot of complexity to the system and additional risk in the system. Now, here's one of the key ones. Our current bank money system is literally inherently unstable. What's the game that banks do? They lend long, say lend you money for 5 years to buy a car, and they have deposits which you can take out at any time, and that's just inherently unstable. If we look at the history of this fractional reserve banking system, it's been bank run after bank run after bank run. The fundamental mechanism by which this risk is introduced into the system is called maturity transformation. That's the term of art for taking it, lending long and receiving deposits short, and it's walking the tightrope at all times. There is no good answer to the system. And our current system basically pretends that risk is not there. We hide the risk. And again, if you mathematically study the nature of networks of risks, hiding the risks always makes it worse. It doesn't actually go away. And here's like the smallest number I could find on how big the number was that we got for hiding the risk. This is the trend line for U.S. national debt. The actual numbers, the blue line is. The green is a extension of the rate at which we were building up debt prior to the 2008 financial crisis. And then the blue line obviously goes well above that. The gap is $2.5 trillion. So the smallest number I could come up with for what was the cost of hiding the risk all these years, at least $2.5 trillion, way larger than that in terms of reduction, and that's just in the United States. And that's also doesn't even discuss the impact on growth in GDP, et cetera. So hiding the risk, it doesn't go away, it will pop up, and I will talk about in this talk some other places where residual risks are still hiding. They don't go away. You can't just wave your hands and say, oh, yes, I can magically change a demand deposit into a 15-year mortgage without any risk being in the system. And our system has foolishly attempted to achieve that. It's just not possible. And of course, due to political reasons, we've made these fundamental problems worse with a non-fundamental problem of marrying proprietary trading systems to this also inherently unstable system. Sometimes proprietary trading is used appropriately for hedges, but often not, as we found out. And then, of course, we know this thing will explode, and prior to layers and layers of regulation and other mechanisms, bank runs were ubiquitous. So instead, we start layering in rules and regulations, which is rigidity and arbitrariness. If you know of anybody of ordinary means who went to try to get a bank loan in 2009, it became obvious that the responses to the instability into the system was to make sort of ridiculous sets of rules that were entirely inappropriate for the actual lives of real people. Then another innovation, which allowed them to hide the risk for a while, was FDIC bank insurance. And of course, that introduced a new problem of moral hazard. In the past, when banks were not insured, at least in theory, the depositor had to take on the risk himself that the bank they were dealing with would go bust and their money would disappear. Once you had Federal Deposit Insurance Corporation there as a backup to the banks, depositors would say, why should I worry, right? I'm made good, so there was nobody keeping an eye on the bank to make sure they were being smart in how they loaned money up until they had more regulation and inspections and ratios and all this sort of stuff. So it's an amazingly rigid and arbitrary system that we have layered on and layered on and layered on to try to hide this risk. Next problem with our current system is we have business cycles, and in our current banking system may actually cause, our monetary system based on banks, bank money system, may actually cause business cycles. At a very minimum, they make it much worse. So if we know that money is created by banks when they make loans, what happens when the economy is going good? The banks are real happy to make lots of loans. They bid up the prices of fixed assets. Money supply is growing. Business goes up. And in fact, they're actually a positive feedback loop mechanism. Unfortunately, they're also a positive feedback loop mechanism on the downside. Again, if you'll recall, right after 2008, banks started calling in loans, even on perfectly sound and solvent businesses, which pushed some of them into bankruptcy. People couldn't get loans to buy cars. The auto industry collapsed. So the mechanism by which money is created is also exactly the mechanism by which money is destroyed. When a loan is repaid and a new loan is not issued, the supply of money in the system actually contracts. And if the velocity of money doesn't change, the GDP will contract directly and linearly the same. And of course, the results are booms and busts. Another problem, a little less obvious until you start thinking about our money system as a network, is synchronization. The 7,000 banks or so, you say, 7,000 is a fair amount of diversity, right? Maybe you don't have to worry about it because when one bank's doing one thing stupid, the other one's doing something really smart, and it all cancels out. Unfortunately, this layers of regulation, et cetera, that I talked about makes the banks act very, very similar. Not identical, but it reduces the heterogeneity of the decisions they make about who to lend to and on what terms tremendously. And also the culture. They're all MBAs from Ohio State or equivalent, in the commercial banking world. And there's a significant amount of interconnections between essentially higher order banks and lower level banks, which enforce another kind of homogeneity in the system. As we know, when we study networks, when you have heterogeneity in the system, you may have lots of small waves, but they tend to cancel out. When you have a synchronous system, particularly under stress, crunch, the wave gets giant, For those of you in the back can't see it, that's a tsunami about to wipe out a city. And so the fact that our banks and their policies are synchronized in how they make money and how they destroy money means that perturbations in the system can very easily become amplified. It's also very difficult to control. Again, for people in the back that says, what part of pushing on a string don't you understand, my son, as the wizard of economic wisdom is talking to Bernanke. The Federal Reserve money system is very indirect, lots of bad data, especially about velocity, time lags on the knobs, the many knobs they have, you turn them and nothing happens for a while, you don't know if it's happened or not, then maybe you turn it back, so you have the classic over-control problem when you don't know if a control is taken effect. And as I mentioned, no direct control or measure of velocity of money. At times, at surface level, it kind of looks like the Fed's doing a good job. Isn't that a nice, pretty line, right? Through good times and bad. The M2 money supply number kind of grows at a fairly reasonable rate. Doesn't look too scary at all. Unfortunately, lots of dancing going on under the surface. Post 2008, our monetary system actually has broken and still to this day hasn't even come close to being fixed. The top is a graph of what's called the monetary base, which is a series of lower level monetary aggregates that discontinuously changed after 2008 and as you see have not returned. Even more peculiar is the bottom graph, which is the excess reserves of depository institutions. Typically banks lend out pretty much what they can, but in this current weirdly broken aspect of our monetary system, there's $2.5, $2.6 trillion worth of money sitting in banks doing nothing. Okay. And another one, which again very few people have commented on, is the velocity of money has been in a very steep decline for quite a long time. And again, part of a side effect of our current broken money system. And just as a by the way, if the velocity of money were to return to where it was in 2008 based on the current monetary money that's been pushed out into the system, we would see 37% inflation. So if our economy actually does come back to life, there's at least some reason to believe we could see as much as 37% inflation. And even if we take the very long-term trend line on velocity of money, there's perhaps 24% inflation sort of built into the dynamics of our current monetary system should velocity turn around and come back to historical levels. Again, in some senses, may be risk that's being hidden through the Fed's policy of flooding the world with money. Next, and perhaps the biggest from a societal perspective, is the current monetary system, I would argue, systematically misallocates investment. And how does a society get rich, basically, and become rich over time? We consume less than we produce. We take that percentage that we have saved and we reinvest it into new and smart things. The intelligence of our reinvestment cycle really will tell how fast we're moving forward. We know there are worse systems than ours. The fundamental failure of Marxist-Leninism was probably about failure to intelligently reinvest, but our system has some deep systematic failures that are cooked in attributes of the monetary system. Here's an example: is debt is always going higher, and here's where the breaking case occurs. And I'll talk in a little bit more detail about how this happens. But because money is created only in the form of debt, there's literally a one-to-one correspondence. When $100 is created by a bank, there's $100 worth of debt created at the same time. It makes debt way cheaper and way more accessible than any other form of capital. So there's a built-in continuous driver of more debt into the system until the system finally broke. This graph, see if this newfangled thing will work here. Is that the laser pointer? Yeah. This graph here is not absolute debt in the system. This is the ratio of debt to GDP. So it grew from relatively small number here, like 1.2 times GDP, to the breaking point was somewhere a little bit north of 3.5. There's no obvious reason in a stable and unmolested monetary system that you should see a continuous drive towards more debt. But the fact that our system is built around debt and money, I believe, is a major vector to drive debt to the breaking point. And we're down a little bit, but we'll probably try to test that breaking point again in the not too distant future. And our good friend Giannakopoulos has also told us that these things tend to operate in leverage cycles. The stock markets go up, stock markets come down, total debt continues to rise. And this is sort of a gloss on Giannakopoulos and a guy named Gorton, I think it is from Yale, who, to my mind, did the best job of really understanding what happened in 2008. I'm going to give you an example, a tangible example of how the nature of our monetary system leads to this ever-increasing wall of debt until it breaks. So basically, we have here hedge fund. 3 guys get together to start a hedge fund, right? We have an investment bank, and we have a commercial bank, okay? And those of you who know Giannakopoulos' work have heard this story before. Essentially, the hedge fund guys decide they're going to put together a hedge fund of asset-backed securities, and they're going to buy it with money that they borrowed from Bear Stearns that's renewable every 2 weeks. So the ultimate short-term money. And so they put up $2 million of equity. Bear Stearns gives them $98 million, and they give Bear Stearns $100 million of asset-backed securities. Now, Bear Stearns has partially funded this by bank loans. So again, there's this funny money coming into the system, and also from other investors in the form of bonds and also their equity capital. But here's the very interesting leakage built into the nature of our system. The current rules allow for something called rehypothecation of collateral, where Bear Stearns is able to take 40% of the collateral they got from the hedge fund and repledge it as collateral a second time. The bank can then loan 100% against that, or very close to 100%. And again, in one night, what's called overnight repos. And this is money that they have just invented, essentially, on the book, as I described. So it's utterly new money. And if it was just money banging back and forth between these 2 guys, that would be okay. But notice, it's actually the money that came out here and came all the way down this system. So essentially, the stack of asset-backed securities and mortgages was significantly driven by this funny money entering the system. And interestingly, this funny money isn't really followed by anybody. It doesn't count against the risk capital of the firm. It's considered to be zero risk because it's overnight. It's 100% securitized. And yet this funny money ended up being trillions of dollars worth. Has been driving a lot of the crazed dynamics that we saw in the later days of our monetary system of late. What was the result? 3 million more housing units built than the household growth rate could absorb over about a 7-year period. And this thing here called M3, this is the measure of that funny money, essentially, and some other things. Notice the funny money kept growing up higher and higher and higher, and then crashed precipitously. And this was actually the shock wave that turned a large economic problem, let's call it 3 million more houses than we need, into a financial crisis. Is when people go, oops, the jig is up, we can't do this funny money for a while. And boom, down it went. And that was the shock wave. My guesstimate is about $3 trillion worth of funny money left the system in 2 weeks after Lehman Brothers. And that's actually the transmission mechanism that almost brought our system down. And this is a fundamental attribute of linking money to debt. And now this is just an interesting cultural, I'll call it anthropological aside. The US government used to publish at least an estimate of funny money, M3 so-called, and they stopped doing it in 2006. Why did they stop doing it? At that point, it was 8%. And they said, oh, that's impossibly high. It can't possibly really be 8%. It must be something wrong with our mechanism for calculating it. So we're going to stop publishing since it's meaningless, right? Then some private parties have continued to use similar methodology, and they actually followed it go up. At the peak, it was growing at 18% a year. And again, that would have been a screaming signal the system was about to break, but the government was not publishing it. This had been as if the physics community, after the Michael Wilkeson experiments in the late 19th century, which showed that the speed of light was constant, said, wait a minute, that's got to be bullshit. Must be something wrong with the mirrors. Forget that, right? And it was that experiment and the continual plaguing of physics with that result that eventually led to Einstein's theories of relativity. So we sort of had a reverse good faith physics in the decision by the Fed to stop publishing the M3 number in 2006. We would have gotten a gigantic early warning signal along in here that things were about to break. Whether that was malice or stupidity, it's hard to know, and maybe it doesn't make any difference. Right? Okay. Now here's a little aside about, actually let me go over it real quickly because it's kind of fun. Current federal debt's $18 trillion, all the funny money floating through the system from the Fed this time, not from abuse of the banks, has an average rate of 2%. We all know bond prices fall as interest rates rise. The historical average federal debt rate is 5%. The value of the federal debt in portfolios will therefore fall when interest rates grow up. I had my bankers at Credit Suisse take a look at the federal debt, and it has an average duration of about 4.6. So a 3% rise, i.e. when the rate the federal government pays on its debt returns to its historical level, the mark-to-market value of the portfolios of federal debt scattered all over the system will come down about $2.5 trillion. Some more hidden risk that's turning up someplace, right? Unfortunately, many parts of the financial system use federal debt as if it were gold, and it's being treated as a very safe asset in the banking system. While if you look at history, it's almost certain that it will fall $2.5 trillion in value over the next few years. And of course, the double whammy is as the interest rates go up, suddenly the amount of interest that the federal government will be paying will go up a lot. Take it to 5% on the current $18.5 trillion, that's $925 billion. The total non-social insurance taxes collected last year was $2 billion. So 46% of the non-social insurance taxes will be used to pay our interest when interest rates return to normal. How the hell is the government going to do that? It'd be impossible to bring negative, in fact, there'll be huge negative stimulus because other discretionary spending of the federal government will have to come down. And there'll certainly be no ability to add fiscal stimulus to save the day by cranking up deficit spending as happened in 2008. And oh, by the triple whammy, just so make you sleep worse tonight, is the Social Security trust funds have already started to slowly spend down their $3 trillion worth of federal debt. It will accelerate rapidly after 2016, and by 2019 they'll be putting out about $300 billion, have to sell $300 billion worth of debt. Who's going to buy all that debt? What's that going to do to interest rates? So anyway, interesting little aside. Now, the mechanism by which all this debt and the proclivity to create debt misallocates investments in a fundamental sense. The way that the rules of banks works, they're supposed to have collateral. And that requirement skews investments towards tangibles, towards factories, towards power plants, towards buildings, towards houses, et cetera. And I've come to believe that that is perhaps the main driver, at least one of the main drivers, and something Keynes identified a very long time ago, which is that capitalist societies seem to have a fundamental problem of chronic overcapacity. Here's an example. This is a measure of utilization of industry, trend line, down, 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 since 1970. In a system that's in equilibrium, capacity and demand ought to be closer to stable. In fact, probably should be going up, maybe a little bit. But instead it's been going down and quite substantially. So we have supply always being ahead of demand. And those were actually the characteristics of the Great Depression, which lasted for a very long time. One could also say it's characteristic of Japan's lost 20 years. And perhaps, we'll know when we read the history books of the future, that may well be the situation we're in today, which is just a systemic problem of too much supply, too little demand, at least significantly caused by the preference of the banking system to put its money into tangible assets. Now, you say, well, how big of an influence could that have? And at first, you might think it's not a lot, but I'm going to show you here that it's bigger than you think. Here's the nature of money. Sue there has $10. Paul's got a chicken, and Mike's got 2 loaves of bread, both of which they want $10 for. So Sue's got to decide what's she going to do with her money, right? So she decides she wants the chicken. And so the money moved one way, the chicken moved another. And basically, that's all money is. Essentially, it's like an electron flowing around the system, unmodified. The money doesn't get destroyed, nor does it get created, as people make decisions to buy a chicken rather than bread or vice versa. Now, you add our new, and this would be the world of Bitcoin or gold, et cetera, where the money is there and is relatively indestructible. Now, you add in our banking system and you think, okay, maybe the banks are adding 6% new money each year through their growth of their loan portfolios, and that is polarized towards debt, i.e. tangibles. And okay, that's relatively big, but is it that scary? I don't know. However, if you think about it more deeply, you realize something, which since money equals debt, every time a loan is repaid, money disappears from the system, literally, not figuratively, literally. And every time a new loan is issued, money is added back onto the ledger. So money is being created and destroyed every time a loan is repaid and every time a new loan is being granted. Let's say an average loan duration is about 5 years. I'm not sure the exact number, but it's probably something like that. That means that the banking system touches 20% of our money supply every single year. So there's this giant attractor in the system of money to come into banks to repay loans and then be dispersed back from banks in the form of new loans. So rather than being 6% of transactions, the bank bias towards fixed assets has perhaps 20% of all financial transactions in our system are biased by loan-making decisions at banks. So that skew is very large, and I believe it would be strong enough to produce those results of increased debt load continuously over time and decreased utilization of our industrial infrastructure. Other problems of our current system, because it's so expensive, 10% of households have no banks at all and are forced onto the mercies of the informal banking system, check cashers, payday loans, pawn shops, et cetera. And this is one, of course, gets lots of press. The bad banksters. This one here is the Federal Reserve spider capturing the world in its web. Maybe a little overstated, but probably not by much, right? Here's a quantitative measure of it. Finance is a percentage of all corporate profits. Currently, it's about 25% of all corporate profits. It reached a peak in the double aughts of almost 40%, and I think by some measures 41%. You have to ask yourself, why should this intermediary that doesn't produce anything be capturing 25% of the profit of the whole world? What the fuck, right? If there's one takeaway, just go, huh, right? It's essentially, ministerial function, relatively value, unadded. They're following the rule book. I mean, 25%, 40%, craziness. And just as something that happened to notice when I was riding around a couple of years ago, Roanoke, Virginia, which is the closest medium-sized city to where I live, about an hour and a half away. It's a couple 100,000 people. The downtown's a small little downtown. And I happened to notice that 4 of the 6 tallest buildings were bank buildings. And wherever you were in town, you looked up and you saw the names of banks looking down at you, right? There was Wells Fargo, something called the Hometown Bank, and SunTrust. And you get away from downtown just a little bit, the 4th biggest building in town, BB&T, and then one of the bigger buildings here is another bank. What's it say? First Citizens Bank. So, this banking animal that's got itself this privileged position in the middle of our monetary system is literally dominant of the skylines of our cities in America. What's that all about? I mean, again, these are guys who just write numbers in books. Why should they have their names on all the buildings in our towns? Seems kind of strange to me. So, is there an alternative? Well, I will humbly propose one. And it's at least partially congruent with some of the things Jordan was talking about. It has some of my own ideas in it as well, of course. And here she goes. First thing to remember is our monetary system was not brought down from Mount Sinai. It's a man-made artifact with built-in winners and losers, and I would argue we can certainly do better than our current system. So what's the system I'm going to propose? It's called Dividend, the Dividend money system, and has 4 principal attributes. First, remember our complicated multi-ledger system, all these complicated transactions to do for Dad to give $50 to his daughter, right? What about if we only had a single ledger? What if all the transactions were done on one ledger? And this is where I say it's important to distinguish between centralized infrastructure and centralized signaling, because this system is a centralized infrastructure system, but will maximize decentralized signaling. So instead of this, oh, by the way, imagine this diagram times 7,000 banks and hundreds of millions of accounts, an unbelievably complex hairball. Instead, we have a single ledger, and entities of all sorts essentially put transactions on the ledger. They put money in, they take money out, whether it's really big guys like John Deere and Vanguard, whether it's small local businesses like Bob's Pharmacy and Mary's Salon, or whether it's individuals. The account structure can be simple or complex. It can be like a checkbook, or it could be like an accounting system. Also simplifies payments. This is to do one transaction on the Visa network. Instead, people have direct connections into the ledger with handheld, point of sale, web PC, servers, and even paper checks. And oh, by the way, the checks could be made super safe by creating a transaction that's only good from me to you. Put that on the check, hand it to you, and you enter that number into the system, and the money moves from me to you. Next big so a single ledger, key distinction. Multiple ledgers today, horrible hairball, very expensive. And oh, by the way, new money does have to enter the system. It would seem to be a truism. We want our money system to grow at about the level of GDP growth, maybe a little more, maybe 2% more. Otherwise, you have deflation. If you have deflation, people don't buy today because they wait tomorrow for it to get cheaper. And so instead of the money coming into the bankers' vaults, what would happen if the money was dividended out to the citizens per capita? So that's why I call it the system, the dividend money system. So we still have new money entering the system each year. It's called 6% a year. If you run the numbers, that comes out to $6,250 per household in America, a non-trivial amount of money. So literally each month, money comes into people's accounts, and it's literally fresh new money, paid monthly. And then we also have a demurrage charge. We don't want money to sit in these accounts and not move around, so we have a balance charge of 2% per year. So if you have money sitting in the bank, it'll decay at the rate of initially 2% a year. This is very important, as we'll talk about later, as a mechanism to control the velocity of money. Higher demurrage charge will increase the velocity. If we charge 10% a year, you want to get rid of that money out of your account. If it's zero, then you're indifferent. You just let the money sit in your account. And then a key point of this system is the supply of money doesn't change except by this 6% growth rate. So all demurrage charges are then redistributed to the population per capita. And if you assumed a person with relatively low bank balance, they may be getting as much as $5,000 per year per household from the demurrage charge, again, moving money out, signaling out to the edge. Okay, 100% reserve system. Money can only be created on the book. It's like gold, it's like Bitcoin when it's created. It lives forever. It may move around, but it's not created or destroyed. This is key, all financial transactions must settle on the book, must explicitly settle on the book. So you no longer have this near money phenomena where things that were securities now become negotiable orders of withdrawal, et cetera. So we make an honest distinction between an investment instrument and money. And just as an aside, this would significantly simplify financial settlements, where there's all kinds of problems in the investment bank world on making sure the money is really there. Here, the money would really be there instantaneously. People would say, well, wait a minute, wouldn't that get rid of a lot of things that banks do? And a guy, Lawrence Kotlikoff, a professor of economics at Boston University, has written a tremendous amount, including some books, on something he calls limited purpose banking, which operates on a 100% reserve system. Only real hard money comes into the entities. And he's demonstrated that anything that the current banking system does can be performed by limited purpose banks. And you can think of them as being a lot like a mutual fund. You own a piece of that entity, and when the time comes to sell it, it may be like a money market that it's always about at par, but it might not be. You say, convert that security into money, and then the money is in my account, and then I move it on. So it makes a clean disjunct between the world of securities and the world of money. And of course, you could still have capitalized financial institutions, but they would not be subsidized with money out of thin air, and they would nor would they be able to hide the risk. The risk would be made explicit. And again, key, nothing is negotiable except dividend money. And then perhaps the most radical part of the program, and I believe important to make it actually work, is what I call radical transparency. All accounts and transactions of all legal entities, i.e. everybody except human persons, are world readable. So literally, we can take a look into the bank account and the transactions of Citibank. We can take a look into the transactions of Monsanto. We can take a look into the transactions of any legal entity and see what they're actually doing. And of course, this also has the bigger question of how do you build trust in the system itself. They will, in fact, and the key part about that, you build on top of the ledger a database and publishing platform that uses the accounts and transactions so that people can easily create analyses that the book is honest, for instance. If we say that the money supply is only growing 6% a year, we just add up all the transactions, add up all the balances, and if it's 6% more than it was last year, then it's being honest. If it's not, it's not. So it's auditable by anybody using a database and publishing platform. And again, I think this is important. We hear people talk about the efficient market hypothesis, that our system must be the best of all possible worlds because we can prove it mathematically, right? Well, unfortunately, the efficient market hypothesis requires full and symmetric information. And currently, our financial system operates by the manufacturing of opacity, frankly. And if we're going to actually get something closer to an efficient market, something like radical transparency would be a big step in getting there. And again, there's access to data. Those data and analyses can be used to create ratings. Reports can be looked for fraud, crime detection. Particularly tax fraud will be much easier to find here. The IRS is losing, I don't know, at least $500 billion a year in tax fraud. It would certainly be nice to cut that number down. As much as we don't like the IRS, if those guys ain't paying their $500 billion, guess who is? Us. So getting rid of tax fraud is actually to everybody's benefit, unless you happen to be a tax fraudster. And then the other thing I think I found very interesting as we're thinking about this system is radical transparency makes insurance affordable or at least honest, right? If you're able to look into the accounts of, say, a financial intermediary, one of these limited purpose banks, someone should be able to write insurance on that fairly precisely against the actual risks that are on the book. And so again, insurance ought to be readily available. So if you want something that is rock solid, then this business entity will need to operate itself on a very prudent basis and buy very strong insurance from a very strong insurance underwriter who's able to write affordable insurance because he has a very deep understanding of the financial moving parts of the entity. So again, risk is visible and priced, not hidden like in our current system where it's swept under the rug at every possible opportunity. So how does our dividend money system compare to the current system? Our current system, as we know, is expensive. Some back-of-the-envelope calculations, I come up with about $20 billion to run a highly secure, very powerful, very high throughput ledger system and all the interfaces to it that would be necessary to do what our current system does. 2 to 7 days to move money around our current banking system, 1 second or less in the dividend money system. Bank runs, inherent instability, et cetera, compounded with layers and layers of rules, made worse by proprietary trading, we actually create indestructible money. Our money is no longer tied to debt, no longer tied to anybody's business decision. The money in the bank is no longer based upon how smart the banker is and the loans he makes. The money itself is indestructible. And hence there's not the mechanism to transmit economic problems into financial problems. There's no maturity transformation around the money, and so literally 2 separate worlds. Tremendous increase in stability. When it comes to macro stability, again, because the money supply isn't under the control of people who are trying to grow it for their own purposes or act defensively, amplifying the business cycle both on the up and on the down, we should see considerable moderation, perhaps elimination of business cycles. The synchronization around 6,000 people who unfortunately aren't 6,000 independent agents, but 6,000 people substantially synchronized by regulation, culture, and interconnections. Instead, we have hundreds of millions of uncoupled decision makers under nobody's jurisdiction. Difficult to understand and control. Only two controls on the real money, on the dividend money system: the growth rate, 6% a year, and the demurrage charge, and those are all there is. And the demurrage charge provides a mechanism to control the velocity of money, which heretofore has been uncontrollable. As a little policy aside, Milton Friedman wrote a lot about what's called the Friedman K% rule, which is reasonably convincing mathematical proof that the optimal rule for money supply is a constant growth rate, because any deviation from that leaves more people worse off than are made better by it, and that number should be approximately the growth rate of GDP. Turns out to be very, very difficult to, even if we wanted to, do the K% rule in our current system because of the lags and the unclarity and the lack of data, et cetera. And dividend money, it'd be real simple. The new money supply growth rate that goes into people's personal bank accounts as citizens' dividends is 6% a year. Therefore, the money supply is 6% a year. And you could add some policy frameworks on top of that. For instance, the legal infrastructure of the monetary authority could require a 12-month lag in any change to the new money supply rate. And again, as a way to encourage stability in that rate. And then something Friedman, I went back and read Friedman's papers, and he entirely missed the fact that he was wrong in that he was assuming velocity was constant. And velocity can change and has over time. The dividend money system also has the ability to either maintain constant velocity or to modify velocity for macro equilibrium. Misallocation of assets, the debt nature and the one-to-one correspondence of money to debt is broken into a world that's agnostic between debt and equity or other kinds of financial arrangements. A world of a network where the diffusion pattern is very centralized, even locally, on banks, and that 20% of the money cycles through them every year. Instead, it's free diffusion, a real free market. Presumably, that should create a balanced allocation between hard assets and not lead to an ever greater buildup of underused capability. We shouldn't have a underlying driver in our financial systems for ever more debt as a ratio of GDP. We should have less debt, and our systems should be more robust. 10% who have no banks today and are subject to predatory finance. Everybody will have an account at no charge, which will be paid for by approximately a 0.1% transaction fee. Compare that to the 2% to 10% that our less fortunate fellow citizens are paying today to check cashing, Western Union, and that's not even to mention payday loans, et cetera, which could be 300% in some states. And this is a little bit more fanciful. Maybe we'll go from a world where banks are looking down at us wherever we go to a world where we're gradually building a newer and better world. Thank you. And if y'all are interested in reading the stuff I did, there's about 200-item bibliography available on that website. So you can dig into it to as much detail as possible. Where are we on time? Okay, because I also, what happened there? Oh, okay. I also have some extra time items. I'll just run over them very quickly, he says. Unfortunately, I can bore people to tears on the subject of monetary reform. One of the things that has, especially when I revisited this, I created this about 3 years ago, two and a half years ago, and I hadn't really revisited it in a year and a half. And as I did, the one thing that jumped out at me is these diffusion patterns are something that really needs more analysis. I think there'll be a very good SFI project is to think about both monetary systems and the currency systems of the sort Jordan was talking about into the nature of the diffusion on the network. What are the sources? What are the sinks? What happens what happens if you had a demurrage system where money diffuses but isn't destroyed, et cetera? You could find surprisingly little research on it. Another item is a system of this sort has new affordances. You can do new things on the dividend money system which are just not really feasible in our current system. An example I call color of money. Instead of all money being alike, it can be somewhat different. For instance, suppose we had decided we wanted to address the money in politics problem. I think that's a little bit of a problem. I do. Suppose every citizen was issued from the monetary authority $100 a year in P money for politics and L money for lobbying. And registered political entities are the only entities allowed to convert P money into standard dividend money, and registered lobbyists are the only people allowed to convert L money into straight dividend money. And you, of course, put the contrary rule on too. The lobbyist may only accept L money, and political entities may only accept P money. And what you've instantly done is made every citizen, from the welfare mother to Charles Koch, on equal footing with respect to their ability to put financial inputs into lobbying and politics. That could be a trivial feature of dividend money. And some other interesting things like you could have revenue royalty personal loans. You could say, for instance, I'll give you a student loan, in return I want 7% of your financial inflows for the next 20 years, right? And oh, by the way, an interesting side effect of that is I now have an incentive of making you, the student, successful. So rather than today, where the bank wants you to actually, even worse, the bank doesn't actually want you to repay on time. They want you to always be a bit late so they can collect fees from you, but you never actually default. That's actually what's in the best interest of the bank. It's a pathological relationship. While in a person-to-person loan built on this infrastructure, it would be in my interest for you to be successful. And then this is sort of wider thought, more into the Jordan perspective. Suppose instead of just using the ledger for dividend money, we had a public read-write API general purpose ledger, like the Bitcoin coin blockchain conceptually, but infinitely better and faster. So I think with that, I'll stop. And take a drink of water. Peter.
So I suppose the first thing that I would want to ask about is, so you say infinitely better and faster. I'm going to pick up on your very last point.
But I'll talk about that tomorrow.
Yeah. The one thing, though, I think, when we talk about the normative value of these different platforms is what the design goal is. And I think your design goal is fantastic, and I like your execution. However, Bitcoin's design goal isn't necessarily to be a very stable asset. It's not necessarily to be a long-term store of value. What it is it's a censorship-resistant currency. And so, yeah, Bitcoin is costly because we have these federated parties who just are, they decide they want to participate in the network and validate transactions. And the way we bond them to honest participation is by making them do something that is provably costly, which is burning a lot of electricity in order to solve these proof of work cryptographic hashes. But the goal there wasn't to build a system that would allow people to hold value, or even necessarily to use in their day-to-day to actually spend in payments and things like that. It was to make sure that if people wanted to make a payment and the legacy systems wouldn't allow them, they'd still be able to. And the reason why I go into this is the interesting potential outcome of a system that you've described is that we move all of our problems from what the mode of signaling is in the economy, what the token is in the economy, what the money is, to what government policy is, because you've decentralized the infrastructure, if you will, and you've made sure we can do helicopter money, getting these tokens into everybody's hands. But there's somebody piloting that helicopter.
Yeah, I didn't really talk about that. I could talk at great length on an architecture for the monetary authority, but you're absolutely right.
Right.
You compressed a series of the problems into one spot.
And so if the answer is then, well, democracy, and I'm not so certain that that's the best way to do this. And the question is, if my main way of transacting in the world is this idealized currency, and then the person who maintains that ledger and maintains that API access, that ability to read write to it, doesn't like me or doesn't like the things I've said about their authority, then I'm SOL.
Yeah. That'll be a topic for another day, but I do have an architecture for a federated structure of 13 decentralized servers that requires a majority vote in real time to sign every transaction. So no one bad guy can do it, and I would like to see very diverse people control those servers. From the EFF controls one, J.P. Morgan controls one. The Colombian cartel controls one. Make them highly diverse, but they all have an interest in keeping it working, and every transaction has to be majority signed. I could talk for 2 hours about that, and you can get transaction rates fast enough for a real economy with not quite the trustlessness of Bitcoin, but close. Yes?
So thank you very much. That was an excellent presentation, and I agree completely with the point that the end goal of your system has a tremendous amount of advantages over the current system. And I can see that that you're hinting at the extra time items, the transitions, because the transition is incredibly critical. The one point that I think we should articulate is in the transition between the current system and the system that you're proposing, because of the nature of fractional reserve banking, there's a tremendously disruptive aspect to that. Either you're going to tremendously benefit asset holders, or you're going to tremendously disadvantage debt holders. You have to make a normative choice as to who you're going to reward and punish in the transition. So how are you going to handle that aspect of it?
Actually, I could go on for days on that one. But in sort of 3 big tranches, this is how I see a transition being done. The ideal world would be a managed transition, which actually manages to dodge that question, which is essentially you tell the current commercial bankers, you can continue to collect on the loans you currently have outstanding. You can't issue any new ones. And at the same rate that depletes money from the system, the dividend money system comes into being gradually at exactly the same rate. So when all current loans have been repaid, we're at 100% dividend money, and in between we're in a mix. As far as I can tell, that doesn't advantage or disadvantage anybody. The second one, and this is probably the most likely, is we have no choice. As I showed you, there's a bunch of hidden bombshells in our financial system, right? If they all go off simultaneously, triggered by some externality, kaboom, game over. Let's say that by 2016, we're starting to get into the range where there are enough of these things all coming together, particularly the having to pay down the Social Security's pile of treasuries, where things are going to be so precarious that we could actually see a complete collapse of the financial system. Because remember, all the tools for managing collapse have been used up, right? There's no more ability to do fiscal spending. There's no more ability to push money into the system. The string is broken, et cetera. All the arrows are out of the quiver, except for one. So when the bad storm comes, there ain't nothing to stop it. And in that system, we may be forced to adopt a system like this and make some hard decisions, right? And then third, I've come up with a method which we could get to through a political process of calling for a debt jubilee, which is a very specific set of who wins, who loses. And then there's a very cool trick here, which is merely stating that that we're in favor of the debt jubilee and we're starting to build a political party, changes the financial force fields in the existing system. Because interest rates consist of 3 components: the time value of money, historically the U.S. Treasury rate, your expenses and profits to do a loan, and your risk. If we now have, let's say, 1% of the population calling for a jubilee ratchet, or debt jubilee, any really thinking person who is selling debt has to build into their calculation the possibility that jubilee will occur and they won't get paid back. And so interest rates will move up, 1 basis point or something, when 1% of the people say they favor a debt jubilee. What happens when it's 20%, right? Suddenly, prevailing interest rates go up quite a bit, because now people are saying, shit, this jubilee thing could happen. I'm not going to price these loans as if it couldn't. It's a real risk. And so interest rates go up. Guess what happens when interest rates go up? People are pissed off about the debt system and support the jubilee. And more people support the jubilee, interest rates go up, et cetera. And I've found some domains where you get a very slow growth in support for the Jubilee until you hit an inflection point where in about 6 weeks the system comes to a crash. Because interest rates go to infinity, the whole system locks up, and kaboom. And people say, hey, wouldn't that be horrible? All that wealth destroyed. Guess what, people? No wealth is destroyed. Money is not factories, it's not human skills, it's not land, it's not a tractor. And I convinced myself of this, that it's actually true, not just theoretical, by looking at what happened in 1922 when Germany, Austria, and Hungary had hyperinflation and basically wiped out their monetary systems and started new monetary systems de novo. Amazingly, their economies restarted in a week, and within a month or two, they were rising very rapidly from the bad effects of the hyperinflation on the way down. So the idea that money is merely pointers that can be easily and inexpensively moved, I'm convinced, is approximately true. Melanie.
So I have a two-part question. The first part is, why is it the right thing to do to link the new money percentage to the GDP? That's question number one. And question number two is do you see feedbacks among the GDP, new money percentage, and the money velocity that might have unexpected consequences for this whole system?
In terms of the first part, the reason is much human psychological as it is anything else. It's thought by people who have studied this that nearly flat prices are the least biased. If you have high inflation, people want to buy now rather than defer to the future and willing to take on debt and do crazy things to buy now because prices are going up. So there's artificial stimulus in the system. If prices are deflationary, i.e. going down, that means, well, I'm not going to buy today. I'll wait for the price to go down, even though they shouldn't. It turns out that algebraically, it turns out it's all a wash because the money value changes and all that. But humans don't work that way. As we know, humans are highly bounded in their rationality. And so the best thinking currently, it's not provable mathematically, but it seems that a relatively stable price regime is the better one to not bias the behavior of these apes with clothes that run around doing all these transactions. As to your second question, what would be are there possible unanticipated consequences on GDP growth from this system? Is that essentially the thing? The answer is, of course. There could be unanticipated, because if they were anticipated, I'd be able to say what they were. But since there's no doubt risks that I can't think of, clearly there's unanticipated risks. But I would say that unlike our current system, we'll have real-time data, literally accurate to the micro penny, right, of what's going on in the system. And we'll have one of our two tools, the demurrage rate, which can be adjusted relatively rapidly, which should have relatively rapid behavioral characteristics. So no guarantees, but all I can say is there's less bogeys in this one than there is in the current one. Jessica.
So evolution's produced biological systems. Can everybody hear me? That have multiple time and space scales, diverse and complicated couplings, and elaborate signaling mechanisms. And our current economy shows the same pattern, our current financial system. And the system you propose seems to want to collapse a lot of that, at least as I heard you. And so it would seem to me, in a way, to be a kind of rejection of biology and, to be provocative, and a suspicion of the utility of information for extracting energy. And I want to just comment before you reply that I'm well aware of it not making the naturalistic fallacy here.
Okay. Yeah, one, I will take Murray's statement, is anyone that thinks that evolution is a good designer has never looked at the design of the human back. Right. So biology does okay, but I certainly wouldn't want biology to design a jet airplane, right? So that's sort of a facetious rebuttal. But in terms of complexity, emergent complexity, I would say you're actually measuring the wrong thing. A system like dividend money may actually increase the complexity of our financial transactions, because the cost of all of our transactions will go down, the precision of them in time will go down, so the things that people can invent to do in finance will actually go up. I wouldn't be surprised to see more complexity in our financial system, but the smart, unbiased kind of complexity, rather than the needless, arcane complexity we have in our current system.
Have you thought about the population growth incentives of per capita dividends, and more insidiously, how people might use the system to implement their population growth wishes?
Interesting. Normatively in our proposal, we say that it's only paid to adults over 18 to not give people a huge incentive to have children, though we actually then modified it later that we give a half payment to children over 3. We chose 3 based on some estimates of hyperbolic discounting by low-income people, who are the ones that are most likely to respond to intermediate size economic stimulus. And if you calculate the stimulus of about $1,500 a year, actually $800 a year over 3 years, it's probably not enough to get them to have more kids. But so anyway, our normative setting is attempted to be neutral on that, although you are correct that one could invert it and say, oh, we're going to pay more for children than we do for adults, and oh, by the way, the death panel says when you're over 65, you get nothing, right? That actually could happen, and that would be an issue of, hey, Celia, if you run off, better give me my wallet back. Oh, okay. Yeah, I got a fat wallet. I've had a good year this year, and I had to put the microphone thingy in my pocket, and there was no room in it with that fat wallet of mine. Chris.
Jim, there's a few quibbles I have with your diagnosis, but I'll do those with you offline. But I'm going to agree with you on 2 big points and disagree with you on 1 big point. The agreement is that one of your big points is that the ability of the banking system to create money is a huge issue, and that's been under-recognized, I think, by economists. I mean, Minsky shouted about it many years ago, but economists kind of largely ignored it, and by policymakers. And there is now a lot of serious discussion of, do we want control over the money supply in the hands of private banks whose incentives are not aligned with the incentives of society? So I think that big point you're making is a very, very important one. And folks like Martin Wolf in his recent book has some very good stuff on that. And the second thing is the dividend policy as a kind of QE for the people, or Friedmanite helicopter money, is very interesting because the problems of doing everything through the financial system and that sort of transmission chain is just so problematic, whether it's blowing new asset bubbles or exacerbating inequality or other things that we're seeing with the current system. So I think those are 2 very positive features of your proposal. Now, the point I'll disagree with you on, you treat the business cycle as a purely monetary phenomena. But there's lots of evidence that there's more fundamental things going on in the business cycle, as well as interactions with the monetary system. And so we're still going to need some mechanisms to move the monetary system in ways that help dampen and counteract the business cycle. And Friedman's views on this, I think, there's a long literature showing why they're wrong, and the nub of it comes down to, if you think about any kind of quantity theory of money, your house has an imputed value, or some theoretical value while it's sitting there, in your possession, but it doesn't have a real value until you actually sell it. The prices are set on the margin; they're set in the transactions. The price that you get for selling your house is going to depend on a whole host of factors, including the demand for houses, the supply of competing houses that are like yours, and so on. And because price levels are actually set on the margin, that a pure quantity theory doesn't really deal with that well. And so in the business cycle going up and down, you have to have some authority that's going to be able to react to the cycle. And having a pure algorithm do it, which is sort of either sort of some fixed rule like Bitcoin, or others have proposed some other algorithms like a Taylor rule or something like that. We've done some work at Oxford showing that that's actually, we've done a proof, in fact, showing that it's impossible. As long as you have any kind of structural change going on in the economy, no fixed rule can deal with it. So I think even in your system, there's going to still have to be, some Janet Yellen equivalent or some structure in there making imperfect judgments, but still the best that we can.
Yep, I think that's a good point. And if you watch the videotape, I think you'll see I was very careful to say I would not eliminate the cycles. But what I do believe is that the cycles are significantly amplified, particularly the big ones, by financial swings. As we know, the housing crisis in the United States was a less than $1 billion problem and was turned into God knows how many, less than $1 trillion problem, and was turned into many trillions of dollars through financial transmission. So I don't eliminate the cycles, but modulate them. Secondly, the system does have two knobs, right? The money supply growth rate can be changed. And very importantly, and I'd love to actually talk to your guys about their simulations, what happens when you have a nearly explicit control on the velocity through the demurrage rate? I've looked in the literature and I found nothing about that. Very, very little. And in terms about, and just as a historical note, current economists haven't focused too much on the impact of banks creating money, but somebody who wrote exhaustively on it was Fisher back in the 20s and early 30s. And if you want to see some really good thinking, go back and look at Fisher's writing from the late 20s and early 30s. Chris?
You've emphasized the radical transparency of the single ledger. Seems to me that a vast amount of our economy depends precisely on non-transparency. What kind of disruption in economic strategy of all kinds of businesses would that radical transparency create, and could we survive it?
There would be many changes, and they would be mostly good. Think about it.
Really, I mean, how do you develop and execute a strategy that you keep secret from your competitors?
Interesting question. It depends on what level your accounts are written, right? For instance, suppose you had an account on the book that says R&D, right?
I thought you were talking about a vastly more microscopic transaction level than that.
Could be, and again, that would be a matter of policy, how far down you want to go. I was thinking about it as about down to the accounting chart of accounts for a firm. That's why I mentioned that the structure of an account could vary from a checkbook to an accounting system and its complexity. And you are right, there could be some, but I would say, at least as a philosophical question, philosophical system, a system built on full and symmetric information over the long haul is likely to be more efficient, though there may be some problems in the transition.
Your demurrage, that you talked about it as an explicit control on velocity. But if somebody didn't want to move money, it would be very easy for some financial group to essentially you transfer it to them and then they later transfer it back. So it looks like it's velocity, but nothing's happening.
That is true. And that, of course, is a problem with the velocity numbers that come from everybody today. Actually, the way the Fed does it is it says, shit, we can't measure this damn thing. We can't separate real transactions from financial contract ones, so they just divide the money supply by the GDP. Okay. You are right. That's actually a flaw I've identified, that one could have some issues there, that the velocity number could be polluted by games. However, the demurrage cannot be avoided because we calculate it in real time, essentially, or close to real time. So the demurrage charge would be calculated once a minute, something like that. And oh, by the way, with some random scatter in where in the minute it's measured. So you couldn't even get into the game of moving money back and forth by the minute, which wouldn't pay anyway because of the 10 basis points transfer charge. That there is an issue at the very core of that that's still to be resolved.
First of all, your plan sounds with a couple of different bells and whistles, like the Simons plan in the early 30s, the Chicago plan. Fisher wrote about it. Other people wrote about it. That occurred after the financial crisis of the late 20s and early 30s. Talked about 100% reserve banking, and that's what you have here. You have a couple of bells and whistles. The other issue is these special purpose banks that are sort of outside the system, it's very profitable to engage in maturity transformation. That's why banks do it. So you could get outside the system, you'll have the shadow bank engaging in maturity transformation. So instead of having it take place in the main bank, it'll take place outside the bank. So you sort of have a shadow bank, or potential for a real shadow banking system on the outside of this, because it is so profitable to do it. That's why firms do it. And then my third point is related to the point raised earlier is that one person's transparency is another person's invasion of privacy. How do you deal with that?
Okay, first, I will certainly acknowledge a significant amount of the ideas here came from Fisher and the Chicago plan. Not all of them by any means. And why now and not then? Because we have networks and computers. It would actually have been relatively infeasible or very much more difficult to have implemented the Chicago plan in 1932 than it would be to implement dividend money plan today. So number two, maturity transformation as a product. Absolutely, it'll happen, and of course it'll happen. There's a need for it, right? But let it be priced as a security and not mumbo-jumbo confused with money and this mumbo-jumbo sort of soft guarantee that no one will ever lose their money that's in the bank. People will lose money making maturity transformation bets if they
That's
don't
what you
want.
have with Gary Gorton's problem is it was all outside the bank where you had this overnight money and you had a problem. I mean, even though it was done through a security, it could be done through a 4-day security.
Yeah, it can be done through a one-day security, right? But it will be transparent on the bank. You'll be able to look at the entity and say, all right, they're doing this particular spread. What's the risk there? Do I want to do it or not? Because it's a transparent publishing platform. On top of it, there'll be people doing programmatic analyses of these, highlighting the risks, which will then make it possible, though not mandatory, for people to get presumably reasonably priced insurance to ratchet up the amount of protection they want. So yes, you can't, again, the principle is you cannot make risk go away, but you want to make it explicit and you want to make it priced.
What about the privacy issue?
As I mentioned, it would not include humans, right? Humans have privacy rights. Do corporations? I would say no.
Jim, what about barter? Would a farmer and a city dweller be allowed to exchange their properties without going through the book? If they require
Yes.
to go, okay.
The only exception I'd put to the no barter rule is that all financial transactions must be settled in dividend dollars. Non-financial things, even industrial in kind. You want to swap steel for trees, go ahead.
Remember the semi-precious metals being trucked around Chicago by Goldman Sachs and stuff? So don't you then create a whole shadow banking industry in the physical world because you've defined it as outside of the requirement to go through the ledger? A lot of games possible there, huh?
Interesting. Good thought. I have to think about that one.
Okay.
Could you, I have a question of clarification. I think you have a wonderful proposal of an alternative system, but the American economy is not a closed system, it's an open system. And I was wondering, lots of US dollars and lots of US debt are held in foreign hands. Could you take me through your second scenario, which I believe you thought most likely? What happens to the foreign holders of dollars and debt?
It's a free windfall to the American people. Fuck you, people. Let us not disguise what's going on. All those Russian mafiosos with billions of dollars in their mattress, bye-bye. Excuse me? If they're holding US dollars in demand deposits or in currency, yeah. Sorry, guys. And oh, by the way, I didn't mention this, and this is theoretical, but actually, the group of that worked on this, we did think quite a bit about the international trade things, and we thought another major distorting force field in around our currency system, which I could go on for another day about, is the fact that the dollar is a reserve currency around the world. And that's probably bad for honesty and non-contaminated transmission of signal in our system. So one version of our proposal actually had a much higher demurrage charge for any entity that was not 100% owned by US citizens. So it might be 2% for US citizens and US-based corporations, and 10% for people outside the United States, when demurrage at 10% rate would not break the ability to do payments very quickly in and out, but would certainly stop the nasty bad habit of using US dollars as a reserve currency.
Yes, as a foreigner, I was about to say that I admire many things about your country, including truly the existence of an institute like the SFI, by the way. But there's one thing that that I really don't understand, and that, if I'm not mistaken, you're still proposing in your new system to have these paper checks. Is that correct?
If someone wants them, I mean, basically you
What
go
is your fascination with paper?
I just wanted to show we were backwardly compatible. Right? I wouldn't recommend it. But as I mentioned, we have a cool feature that you could go on your computer, say I want to send $10 to you, get a large number, write it on a piece of paper, hand it to you, and you can lose it. No one can use it. The only thing that number is good for is to trigger the transaction A to B. Leighton.
So Apple's announced exactly that system, and they're not the first after Square and others in payments. Apple could pull off a lot of what you just described with more trust than some of our institutions.
Yeah, it might be a good subcontractor for the monetary authority.
And that leads into another question I had, which is, what kind of, do you have nuts and bolts in mind as far as how to actually, so you say, like, we would have Irving's plan, but we couldn't have had it back then because we didn't have computers, and we have computers now. Sometimes I worry we say, oh, we have this computer, it's a magic box, it'll fix the way we do it. I guess some of my more specific questions to that end would be, do you envision a blockchain type system? You say that we'll be able to target the demurrage rate to different individuals based on knowledge of whether they're different individuals, different corporations based on knowledge of whether they're majority U.S. owned, or I suppose whether they're a U.S. citizen or not. How do you link identity as a legal concept to the cryptographic key pair that is actually the nuts and bolts of how the person is given authority on the network to transact? How do you prevent fraud there? That sounds like a massive bureaucracy. Additionally, if you're worried about that kind of fraud, you're going to need the ability to reverse transactions on the ledger from some centralized choke point of control. And that is an incredible amount of power to give even 12 federated entities, as you said. It was your more exotic plan that you can talk 2 hours about. But I'm worried that the technological systems that you're using to say that this is possible are not at that level yet, which is why Bitcoin is a horribly environmentally wasteful currency on a certain level, but it's not when you realize that what we're paying for is not efficient transaction processing. It's the fact that we can't trust anyone, so we need things to be expensive.
You know, of course, Bitcoin, you can't reverse a transaction, right? So you are right. There's a number of implementation questions to be answered. If you want to talk offline, I can bore you a lot about our thinking so far, but it is certainly incomplete. We do anticipate that the system will have to have some human judgment in it about reversing, not dissimilar to our current payments program. It can't be a black box, right? One of the big downsides of cryptocurrencies. Well, actually, it's an upside in certain fringy, semi-criminal environments. In the real world, it's...
Call it freedom.
It has its other issues. So there's work to be done. There has been some thinking, nowhere near enough. And if you want to hear what thinking to date, and you need trouble sleeping tonight, I can drone on for a long while.
With the centralized control, even 13 centrals, is it possible that we might find that certain selected groups of people can barter for better demurrage rates and better dividends than other who might not be as politically popular?
Of course, unfortunately, any political system is subject to political capture, which is one of the reasons why I mentioned and have actually coupled in a policy package the idea of breaking the money in politics linkage. If we went to the P money and the L money, where every citizen had the same influence through money of the political process and through the lobbying process, while it doesn't absolutely guarantee lack of capture, it certainly reduces the probability of it way below what we currently have.
I think I missed your point explicitly of how you set the amount of money actually there to start with, and then you allow for growth rates. And a sort of a corollary to that, haven't you sort of reinvented the gold standard by having a fixed amount of money which allows to be increased a bit as you mine more gold?
Partially. The indestructibility part, though, of course, gold has the problem. It's not actually indestructible, and there's a significant leakage between gold, the currency, and gold, the jewelry, and gold, the industrial product. Further, the growth rate of gold is only very loosely coupled to the growth in GDP. Historically, there's been all kinds of changes in the gold supply when new major fields were discovered, when the cyanide extraction method was discovered, which ended up causing a massive shift in all kinds of crazy things in the late 19th century, late 19th century. So gold is sort of a hypothesized gold partially, but unlike gold, our rate is set by policy of tracking the GDP. In terms of the amount of money, algebraically it doesn't matter, frankly, what the number is. As a matter of convenience, we thought for the reasons of being able to do this gradual transition where current banks stop issuing new loans is essentially map the target amount of money to the current M2 number so that people would have a number that they're psychologically comfortable with. A dollar is about equal to a dividend dollar.
I was using gold as a figure of speech, but since I have the microphone, since it's impossible to get a national health system agreed upon in this country, I think it's totally impossible to see your scheme implemented.
Probably number one has a low probability, but reacting to crisis, I think there's a good chance we'll have a cataclysmic financial crisis in the next 5 years. And if a political party were to be started campaigning a debt jubilee, it might work in 20 years.
Like it did in Germany?
All right.
Hyperinflation.
Let's take this offline. Thank you very much, Jim. It was wonderful talking.